So how are you weighing these risks? We're talking about the U.S.-China trade talks, of course, some questions about lending here in the U.S., a lack of economic data, at least until we get that CPI that has a lot of investors very concerned. How are you weighing all this when it comes to the markets?
Well, I guess we're anticipating a return of the volatility, frankly, that we expected from Trump's victory in the election last year. We know there's going to be some bumps and maybe a few more bumps. Always, I guess, if you're a long-term investor, as we try to be, you want to think about what's the broad trajectory, which we still see as positive. So very much aware of these concerns, paying a lot of attention to them. But really think that, certainly for the U.S. at least, it is a pretty good outlook. You're going to have these occasional concerns, certainly around credit, which, if anything, are likely to increase as lending picks up in the U.S. To support the manufacturing renaissance and also to support further AI development. So it's a bit part and parcel.
Right.
If you want the growth, you have to accept the volatility that comes along with it.
Okay. Does the government shutdown here in the U.S. in particular, does that create volatility in the U.S. markets in your mind? And do you think that leads more investors going to gold? Again, we've seen gold surge to records. Or does it actually create moves in the equity market where investors get more defensive?
Probably a bit of both. I think we also know from a lot of experience with these shutdowns that in the end they're not really that impactful. You know, maybe this time is different. I think we're the third longest, so we've got a ways to go yet before it becomes the longest. Hopefully we don't. But really, if you, for example, have government employees that aren't receiving their salaries right now, they should do in the future, and so that consumption comes back. So for now, on the margin, sure, a little bit of nervousness, some benefit from gold, for treasuries. But for the most part, we don't think it's the main issue for the markets.
All right, you seem pretty calm about all this. Let's talk about earnings season. What's your take on earnings season so far? I also want to bounce this off. If you look at the Mag 7, their earnings are expected to be up about 15% year over year, but the other 493 up just under 7%. What do you think that means when it comes to flows going into different equities? Do you think that pretty strong earnings from the other 493, does that lead to the market broadening out, or does the money continue to go in the mega cap tech names?
Well, I think if you look at earnings, that actually may be painting an even more stark picture. If you look at tech more broadly beyond the Mag 7, our estimate is that earnings will be up 17% for them versus 2% for the rest of the market. So same idea, but maybe even a bigger gap. But it's exactly the divergence that we see there. Because you've got to recognize that the non-tech parts of the market, the value, the goods producers certainly are suffering because of the tariffs. You can't deny that. Hence the depressed earnings growth relative to what you might have expected at the beginning of the year. But it's exactly for that reason that our overweight in U.S. equities is to NASDAQ. We see the superior earnings growth there. Certainly we can talk about valuations, but that's why we think that's a better bet. We're going to need to wait a while for the other parts of the market to work through the tariff shock to get a bigger recovery in earnings before we really think we might find that part of the market attractive again.